So within the last week, investors have been treated to headlines telling them that this is the worst stock market since 1939 on Thanksgiving week. And then this week, seen with the Fed announcement that the stock market has one of its biggest rallies of the year. So what's going on? Where are things headed? We discussed this week. So we've been doing our best to caution investors about the type of market environment we're in, because our biggest concern right now is really that people are going to fit into one of three likely scenarios. They're going to get way too pessimistic and read into those headlines like last week, worst Thanksgiving week since 1939, first time in years that all 4 days around the holiday were in the red for the stock market. Or conversely, they're still way too optimistic. They're overweighted to equities, particularly U.S. equities, growth U.S. equities, and really not aware of some of the underlying risks that are around. And for basically everybody else, perhaps a large degree of confusion as to what to make of these rallies and sell-offs. And again, a lot of good data that's out there and a lot of bad data, and really where to place their trust. So what does this all mean? It means, as we talked about since last year, that we have a floor below us, really good corporate earnings, again, an earnings yield on stocks north of 6 compared to a treasury rate of about 3. If that yield, dividends minus market value, is better than the treasury rate, that's usually an okay to good environment for the stock. So another way of saying stocks are attractive. Earnings in general are still growing. Macro data around the world is okay. It's not bad. And so that's where that creates that floor. The problem for those who then say, well, if it's good, then I should expect stocks to just go up and away, is that moving a market higher isn't so much about things being good or even just growing, but relative rates of change. The question there isn't, again, good or bad, but is it better than it was? And without getting that better, which we're not getting in this environment, that's where you've got this floor and the ceiling, and stocks tend to chatter between the two off the headlines you've been reading, whether it's growth scares in tech, Brexit, Trump and politics, trade, all the different things that have got investors staying up at night, but really aren't going to break that trend upwards or downwards on their own. That's, again, a macroeconomic environment. So our caution here to clients is to stay patient. For the pessimists out there, because they're starting to mount, I would just say this to the investors listening to this. I've yet to, in my career, which is now 25 years, spanning two of the worst sell-offs the stock market's seen, I've never seen anybody call it. There's way too many people calling for market crashes or recessions for me to think that one may occur. If it does, that it's going to be too deep or too bad. That's just not how they work. They usually jump up and catch people, again, the majority of people, by surprise. And so again, that makes me think the cycle probably isn't done, but again, isn't a cycle to be out taking too much risk in either. There's a chart, we're gonna pop it up on the screen right now, from JP Morgan, that I think is important to keep in mind too, which is, pessimists don't get paid over time. They can be right for a moment in time, but more times than not, the market proves to be far more resilient than the pessimists have proved to be right. This chart, one of my favorites, we've shared it in commentaries in the past, and as you see, you'll go through these long periods of flat, if we follow along with the green line on your screen, followed by years and years of gains. And so I think there's a few big takeaways I want you to have from this and place somewhere deep in your mind the next time that scary or enticing headline jumps up, which is, number one, despite going through a lot of different things, whether they're wars, again, countless recessions, those are all those gray bars you see, markets have moved up over time. It is true there's a lot of volatility. Again, to that end though, I would tell you all that little day-to-day volatility that makes for great newspaper fodder doesn't look like much when you stretch out that time frame. But the question remains, whether it's the volatility or just those flat periods on the green bar, how do you get from point A to point B? And I think that's the thing that investors stay up at night worrying about. And that's exactly why we talk about having a plan, having a partner, and a process that can get you through that. And for the vast majority of clients, that plan, that process is going to be wrapped around having an income stream that's commensurate with your needs. And that's why we talk about that. If you've got that income that you can rely on, and you're not relying on a return that the market just may not give you. We don't know if the green line is going to continue higher, or we're going to begin to head into a prolonged flat period as has been represented in the market history. We need to have a plan that works in either one of those scenarios. That means income, because of capital appreciation on your stocks or your bonds or your real estate, it just may not be there when you need it. It reminds me, since it's the season of one of my favorite movies of all time, It's a Wonderful Life, when there's the run on the bank and George Bailey's there with his honeymoon money, and he's telling everyone to stay calm and stay patient. And the one lady says, "But I've got children to feed." And we get it, and that's why so much of our plans, again, while absolutely about finding the best managers and looking deep at theory and quantitative analysis and all those things, ultimately have to be very pragmatic and built for the practical lives that our clients are living. And that's, again, if you're not a client of 10 Capital, the thing we would challenge you to really ask about your portfolio. Is it there now? And if it's not, why? It should already be and have been positioned for that, so that, again, there's something that you can look to find a win. That's that critical component from an emotional perspective to be able to anchor to. And then from a financial perspective, again, that win, if it is that income generation, is that thing that can sustain you financially through what could be a turbulent or flat period for the markets. We're going to end it there. I would throw out, for those of you who are so interested, we do have a podcast, which many of you may not know. You can find it on Podbean. You can find it on iTunes. The title is Pulling Back the Curtain. We look at a whole host of different things, from entrepreneurship to different philosophies that we have here at 10 Capital. We bring in a number of guests. One, Amber Millam from Henderson Global Income Fund, came in to talk about income and where Henderson sees the global equity markets heading, and dividends in particular heading. It's episode 6. Encourage you to check that out. Also wanted to remind everyone about our holiday party coming up on December 14th at the Mack Museum here in Spokane. Would love to see you, your kids and grandkids at that event. And to that end, hopefully we'll see some of you tonight if you're catching this video on Friday, November 30th. We're the proud sponsor of the Holiday Bash for the Community Cancer Fund, a great, great cause that we're proud, again, to be a part of. With that, thank you so much, and we'll see you next week.